Hey, what's up, everybody? Today I want to talk about Starbucks Corporation, and I'm really concerned about the stock. Now, I'm not concerned about the company. I think the company is amazing, fantastic. They have an incredible brand. I think it is one of the top 50 companies in the entire world, but I don't think management has been running the company really well, especially on the financial side. And I think they've been very careless on how they've been running the company. I think it's catching up to them now. And I'm really concerned about the stock over the next year or two. And I'll explain more why in this video. Now, as I do this video, the stock is at $73. A year ago, it was trading at 30% more. So the stock is down roughly 30% over the past year, and it's down 21% year to date. So before I get into why I believe management has carelessly been running the company the way they've been doing, I first want to focus on why the stock has dropped almost 30% over the past year and has significantly dropped over this past week. And it really has to go to their guidance for 2024. And so this is a presentation they did about 6 months. So this was, I think, the third quarter of 2023, and they gave guidance for 2024. And this is what they said. So they said 5 to 7% comp growth for their stores for 2024. They think revenue growth for the entire company was about 10 to 12%. So organic growth, that tells me around like 5%-ish for the year. And then earnings growth, they were suggesting was going to be around 15 to 20%. Just in the past quarter or so, they've completely revised their guidance down significantly. And that's why the stock has fallen so much. So if we go back to their latest earnings report and look at what they're saying for guidance now. So they're saying that global revenue is going to be in the low single digits for 2024. And keep in mind that they were saying before it was going to be in kind of the high to low double digits. So right there, that is a significant fall off. In addition to that, the comp growth, they're saying low single digit decline to flat. In fact, really across the board, they're saying low single digit to flat overall, where the comp growth before, they were saying that it was going to be around 5 to 7%. So now they're saying almost flat. So that is a significant drop right there as well. So how about full year EPS? Well, the new revised guidance is saying that from a GAAP perspective, it's going to be flat to low single digits. That is a significant fall from when they were saying earnings was going to grow 15 to 20% for this year. So these are really unfortunate, bad revised numbers for Starbucks. So why do they think, and what's kind of causing the significant drop off from revenue and earnings? So to determine this, I went back to the last earnings call and I listened to the whole thing. And it was pretty enlightening to hear management talk about kind of what Starbucks is going through. And a lot of other service industries are kind of going through the same scenario. So this is what management is saying what's going on. So they're saying in this environment, many customers are being more exacting about where and how they choose to spend their money, particularly with stimulus savings mostly spent. We saw this materialize over the quarter as customers made the trade-offs between food away from home and food at home. Against that tide, we need to be able to reach and communicate with our customers in a way that demonstrates our value, particularly through Starbucks Rewards and Starbucks app. So management is coming out and saying that people are looking to save money. All that money that was from stimulus, 4 years ago is completely spent at this point. Not only that, if you think about it, with inflation going up, interest rates going up, people have less money in general. As gas prices have gone up even recently as well too, people are going to have less money to spend. So they're going to go buy food to put on their table from King Soopers or Kroger or Sprouts or whatever, or go get a latte at Starbucks. They're going to tend to buy food from the store and then bring it to the house to cook. And that's what we're kind of seeing right now, where Starbucks is more discretionary spending, more of a want than a need. However, they do talk about in their earnings call that a lot of their loyal customers that are part of the rewards program were still pretty heavy in spending. And there was not much of a drop off from that. It's really the casual spender at Starbucks. So in general, over 50% of the Starbucks customers are in their rewards programs. These are more loyal customers that continuously go buy Starbucks more than once a week, where the casual consumer may just be buying, here or there. So how did their Q2 numbers play out? Well, they were not good. So in Q2, their company had $8.6 billion in revenue. It was down 1% year over year. And again, remember those forecasts that they were saying they were going to have revenue in the 10 to 12% growth. So in that quarter alone, they were down 1%, which is substantial. Their global comparable store sales declined 4% year over year, driven by a negative 3% comp growth in North America. Keep in mind, again, they were saying comp growth was going to be positive 5 to 7%. So this could be like a negative 10% drop from where they thought they were going to be in 2024. And they said that comp growth really was led by declining traffic and a negative 11% comp growth in China. Their global operating margins contracted by 140 basis points to about 12.8%. And their overall earnings per share declined by 7% to 68 cents. So needless to say, it was a bad quarter for Starbucks. So the company is trying to combat the decrease in sales and their earnings by focusing on a couple of things. So one thing they did identify is that they want to improve the wait time for their customers. They believe that some people are just not going to Starbucks, or they're getting in line at Starbucks and leaving just because the wait time is more than what they want to wait for whatever latte or cappuccino that they're waiting for, and they want to provide more transparency for their customers as well. Not only that, but they believe that some of their customers haven't come back because of product availability. For example, they talked about their potato, cheddar, and chive bakes that were a big hit with their customers, but was so strong in demand that they were not able to offer them at 2,000 of their U.S. stores. So you definitely have to commend management for trying to look at things they can control and can improve. But that negative 3% comp growth is certainly concerning. So I mentioned earlier in this video that I am really concerned about management and really the way they've run this company over the last 4 to 5 years. Again, I think Starbucks is an amazing company with an amazing brand, but I have apprehension around the management group and really the way they've been kind of careless about how they've been running the company from a financial perspective. And I'll show you why. So this right here is the cash flow statement from 2018 to 2023. If you're wondering what this platform is, it's ticker Terminal. And you can see this line up here is net income, and they are positive net income over the last 5 years, which is absolutely tremendous. $4.5 billion of net income in 2018, $4.1 billion over trailing 12 months. So good numbers, obviously. Now, if we kind of go down to cash from operations, they had almost $12 billion in 2018, about $6.5 billion in the last 12 months. But they've been around, I would say, around that $5 to $6 billion number. And then if you take their capital expenditures, which is this line here, to get free cash flow, you take cash from operations minus capital expenditures, also known as CapEx. That will give you free cash flow. So, for example, if we take a look at the last trailing 12 months, $6.5 billion of cash from operations minus $2.5 billion in CapEx. So that is roughly $4 billion of free cash flow. So that is what the company has left over after running their business for that specific period of time. So $4 billion, that's a lot of money in general. However, this company is a $100 billion market cap. So I would argue that a $4 billion free cash flow number isn't great. Even though it's a lot of money for a $100 billion market cap company, it's not fantastic by any means, but at least they're earning a good amount of free cash flow. What is concerning to me and why I think management has made some really bad decisions, and it's going to catch up to them now, and I'm really concerned over the next year or two. If we go down to the financing section of the cash flow statement, so this is the area where we get to see how much the company is spending on buying back shares, how much they're spending on debt, repaying debt, also paying out dividends. And this is where it gets very interesting. So their dividends paid for the trailing 12 months is $2.5 billion. The repurchase of common stock was $1.8 billion. So if you add those together, that is $4.3 billion. So that is actually more than the free cash flow they've brought in. It actually gets worse if you look at even previous years. So for example, if you look at, well, let's just say like 2022, their free cash flow was $4.4 billion of cash from operations, about $1.8 billion for capex. So if I'm doing that in my head, was that roughly like $2.5 billion of free cash flow in 2022. If we go down here, repurchase of common shares, $4.1 billion. Then you add in their dividends paid at 2.2. So they paid $6.3 billion in dividends and buying back shares. And they had less than or around, say, $2 billion worth of free cash flow. So that is very, very concerning. And you can see that over the last 4 or 5 years, they've been buying back shares and dividends at a much greater rate than they've brought in for free cash flow. And so that works if you can do a couple of things. So one, if you go and finance, and so you go borrow money to buy back shares or pay your dividends, which I don't think is a great way about running a business. There's certainly some companies that have done that. RTX, Meta has done that as well. Another thing companies can do, it's really hard for Starbucks to do this because they're not really set up this way, but trying to use future earnings to pay for dividends and share buybacks now. So companies that maybe are SaaS companies, so subscription type companies, insurance companies that are getting money up front for services or products that they haven't even had to fulfill yet, they can take that free cash flow, which are again future earnings of the company, and then utilizing it how they want. Starbucks isn't necessarily set up that same exact way. Certainly, they can leverage some of the reward programs and things like that. But I think what Starbucks has done is kind of a hybrid between borrowing and leveraging debt for the future, and also leveraging future earnings to pay back dividends and repurchasing shares as well. So now the company and management is sitting at a very troublesome situation because now their earnings are not growing, the revenue is not growing. They're in a position now where I do believe the dividend is in trouble. Not that they'll stop paying it, but they only can do really one thing. They could actually borrow even more money going into the future to continue paying back their dividends, or most likely what they're going to be doing is they're probably going to really start slowing down their share buybacks in general. Maybe they'll keep the dividend the same and they'll just completely stop doing share buybacks altogether. And another thing that is really concerning about Starbucks and the way management has run this company is looking at their balance sheet. So their balance sheet is simply your assets, your liabilities, and your equity. And how that balance sheet works is actually assets equals liabilities versus equity. If we go down to the equity section of Starbucks balance sheet, look at this, negative. So it's very unusual to see a big company, especially great companies like Starbucks, having negative equity. Now, that doesn't necessarily mean right off the bat that you should be extremely worried about a company. Certainly when they're buying back shares and doing some other things, you could see equity decrease on that. However, I am concerned about Starbucks because if you look at their liability portion of their balance sheet, it has significantly grown. So right now, as of this last quarter, it's at $37.8 billion of total liabilities. If we go up to total assets, it's at $29 billion. So if the company, and I'm not saying this is going to happen, it's very unlikely it's going to happen, but for some reason, if the company were just to go to business today, they do not have enough money on the asset situation of the business to pay for their liabilities. In fact, they're short almost $8 billion, which is a serious problem overall. And we've certainly seen companies actually take some of this same approach. There's another smaller company out there called Sleep Number. They make beds. You may be aware of them. The management has kind of done something similar there. They did not leverage dividends, but they leveraged buybacks. So what they did is at every single piece of free cash flow that came into the business, they just threw right at share buybacks. In fact, they almost had no working capital at all with the business. They were putting it all to share buybacks. So they were kind of non-organically increasing their earnings per share by doing all these buybacks. And that's okay if the company's free cash flow is growing, the company is growing, you can kind of stay ahead of that. But as revenue drops, as free cash flow drops, that's when you run into issues, and that is what's happening to Starbucks right now. In fact, if we jump over to their financials and take a look at a couple of metrics here that I think are important. So, from the growth of the company, their sales per share has grown 12% per year. Which is fantastic over the last 10 years. A lot of that is propelled by those share buybacks they were doing. Earnings per share growing 11%. Now, free cash flow, it's not calculating because actually a negative free cash flow back in 2014. So my formula here is kind of bombing out. But you can see over the last 3 years, they've grown 200%. And it has to do with those buybacks that they were doing. Book value per share, because equity is negative right now, book value is actually decreased. This should be a -2, not a +2, but it's actually decreased by -2% over the past 3 years. That's on a CAGR basis. Now, return on invested capital, phenomenal. The company's done a fantastic job on taking investor money, also income from the company, and be able to turn that into profits in general. And the return on invested capital has averaged 31%, which is one of the best I've seen in the market, which is fantastic. But from a debt situation, from an equity situation, it is very, very concerning. So their long-term debt to free cash flow is 3.9. That's not too bad. Their equity right now is negative. So the debt to equity is actually a negative number. Their current ratio is actually under a 1. And again, that's just going back because everything that's coming to the business, they're just trying to put towards share buybacks and dividends. And with their revenue decreasing, their earnings per share decreasing year over year for the past quarter, and their 2024 guidance decreasing for the year, the PE, or what the market has been willing to pay for the company, has dropped significantly. So you can see in 2022, 2023, the market's been willing to pay around a 30 multiple. It has dropped all the way down to a 19 multiple here today. Now, gross margins have been averaging 28% over the last 10 years. Very, very consistent. And then their operating margins have been around 15%, which is really good. If you can get 15% operating margins from 28% gross margins, that is a very, very efficient company. So numbers-wise, there's some really great things to see here. Growth from the company, return on invested capital, but the balance sheet is a very big concern for me, and I think it's really going to come back and bite them in the butt. We've already seen a decrease in stock price by 30% over the past year. I think Starbucks has a difficult road ahead of them over the next year or two because of how management has run the company. By leveraging debt and taking all their money, including future earnings, and pushing it into buybacks and dividends. So it certainly has been amazing for investors over the last couple of years, but I think it could potentially hurt investors now and in the future over the next year or so. So now let's do a valuation for Starbucks and try to come up with a good intrinsic value or fair price for the stock price here today. Now, the company in 2023 did $36 billion of revenue. Now, the company has come out and said it's going to be flat to low single digits for 2024 for revenue. So I'm going to give them benefit of the doubt, say they're going to grow 3%. They're not going to be flat. They're going to have 3% of revenue. So that's going to be around $37 billion for 2024. I think it's going to kind of be 5% growth in 2025, 8% in 2026, and then 10% 2027 and 2028. So I think over the next 3 years, it's going to be kind of slower growth, and then they'll pick it up. So I think this is pretty generous for the company, which comes out to about a 7% revenue growth over the next several years. Now, as far as operating margins grow, they're at 15.3% in 2023. I think it's going to be around 15% on average over the next several years, which has been very in line with where the company has been historically over the last several years as well. Now, that means the company's operating earnings will grow roughly 7% per year, which is in line with their revenue. Now, this is where it gets really, really interesting. What is the multiple that the market is going to pay for Starbucks stock? in the future. And, we could see that, a year ago, they were willing to pay a 30. 2 years ago, they were willing to pay a 33. Right now, it's a 19. Now, if we go back and we look at 2017 to 2019, I think this is probably kind of close in line where I think the market is willing to pay for Starbucks. So they paid a 21 PE for over a 3-year period. I think that is where Starbucks is going to fall. Again, this is just my forecasting, my prediction, but I think a 21 is very reasonable for the company with a 7% growth. I think buybacks are going to significantly slow down. I think they'll probably continue doing the dividend, but we're not going to see that earnings growth that we've seen over the last few years. So I think a multiple 21 based on the return on invested capital and how amazing the brand is. Now, based on this information, I come up with an intrinsic valuation for the company at $70 here today, and the stock is trading at $73. So I actually think it is trading around fair value with what the stock should be trading at today. Potentially even is trading at a little higher than where it actually should be based on these forecasts that I'm coming up with. So I'd love to hear from you guys in the comment section. Are you guys on my side, believing that management has run this company really carelessly, that they've really over leveraged the company, they've been borrowing against future earnings to buy back shares and paying dividend? Or do you think management made the right decision? The company and the stock is of really great value here today. I would love to hear from you guys in the comment section. Thank you so much for watching. If you're curious on how to value companies yourself, I do offer different valuation templates on my Patreon. I'll put a link down below if you'd like to go check that out. You also get access to my Discord channel with over 100 value investors over there as well. Thank you guys so much for watching. I really appreciate it. I'll catch you on the other side. Take care and God bless.